Good morning, and welcome to the Bober Markey Fedorovich webinar on business and individual tax planning moves to consider before year-end, presented live on Tuesday, November 16th, 2021. Thank you for joining us this morning. As we all know, the uncertainty and challenges from 2021 have continued into 2021, and we will most likely join us as we ring in 2022. During today's discussion, we're going to review what's changed, what's coming, and what planning steps you can take before year-end. If you're listening live, please use the Q&A box to submit your questions, and we'll address them as we go or at the end of the discussion. If there are any questions that require an in-depth response, we may follow up with you offline so that we can dedicate the appropriate time and attention to your inquiry. This live presentation qualifies for up to 1 credit hour of CPE. To qualify for CPE, we're providing polling questions throughout the presentation, which need to be answered during the webinar. This presentation is also being recorded, so you'll be able to review the presentation later. If you're watching the recorded version and have questions, you can email your questions to info@bmf.cpa. With that said, I'm Tyler Chaplin, a manager in our tax department, and joining me today is Melissa Dunham, Senior Manager in our tax department, who will be kicking things off for us. Melissa, go ahead.
Thank you, Tyler. So businesses thought that they were temporarily changing the way that they were operating in 2020 due to COVID, but it has continued through 2021 and is still ongoing. It has affected the way that essential and non-essential businesses are operating. Employees are working from home and performing effectively versus being in the office. Some businesses are reconsidering how they are operating and changing the way that they are doing things. Because of this, I am starting with the business section today, discussing the state and local tax considerations. Whereas in the past, we have typically ended our business sections with the state and local piece. So I'm going to start by launching a polling question to see what you're doing. Are you working from home? Are you working in the office? Where exactly you're working? So as you're answering, I'm going to continue, and then the results will be posted so you can see what everyone's doing. So in this working from everywhere or anywhere new era that we're entering, I'm going to start with the municipal taxes, which are the cities where you're performing services. Typically, an employer should be withholding city tax based on where an employee is working. This is where you should be withholding, which is primarily where you're working. But when you're just work from home occasionally, such as you have a plumber coming to fix some pipes, or when I go to a client location in Cleveland while I'm based out of an Akron office, they don't change my withholding for that period. But going forward in 2022, this all changes. If you have employees working from home, Ohio had come out and said with legislation that they passed that through 2021, as COVID was still considered to be temporary, that employers could continue withholding from the primary work location before all this started, unless they have a new policy in place. This was to help the cities. For example, the city of Akron, they were concerned if the employees from Akron Children's Hospital were not working there anymore and they were working in their home jurisdictions, they would lose those tax revenue, or Gojo and the other large employers that are based out of Akron. So to make it easier on the employers and to help those cities, they delayed putting this into effect. So starting in 2022, if you have a policy, then you need to start withholding based on where those employees are actually working. Even if it's an unofficial policy and you're just doing it regularly, such as you let your employees work from home on Fridays, that's still 20% of the week that they're doing it. So as you're looking at it and thinking at pulling together a policy from working from home, and you're going to change the way you're doing withholding if you're going to be doing this, we would recommend using percentages versus days. For example, what if you're working on a Saturday or you're taking a vacation day? If you say, and this is what I'm doing at my employer, I'm working from home 40% of the time, and I'm in the office 60% of the time. There's some weeks where I'm very busy and I have to work as a team in the same room, and I may be working from the office that whole week, or I may be at a client location. We're not going to change the withholding based on that weekly. It's an administrative burden for the HR, but over the year, I will even that out. So over the year, I'm going to work 40% at home and 60% in the office. So this will be a big change for payroll. So if you're considering this, you're going to need to talk to your employees, talk to the HR department, talk to the payroll company that will actually start remitting these receipts to those cities. And along with this, you then need to consider the income tax repercussions of this and the compliance that will need to be done from that perspective. So the income tax piece, you have employees now working from different jurisdictions. For example, I have one client who just has an office in Fairlawn. They've historically filed one income tax return. Based on this, with their employees, they could be filing now in 10 cities, 15 more cities, not just Akron. They may or may not be paying more tax, but it'll probably be a little different because the tax rate in Fairlawn is different than the tax rate in Akron or some cities. Or in my case, I also live in a township. So those days that I'm working from home, that 40% of the week, my employer isn't withholding city tax at all. And I won't have those wages apportioned anywhere in their apportionment when they do the income tax returns. So there could be some differences, positive or negative, but the biggest piece is the compliance burden to go from filing one return with one extension and one set of estimates to possibly 10 returns, 10 extensions, 10 sets of estimates throughout the year. We would suggest filing through the Ohio Business Gateway and electing into the Ohio centralized filing system. This is a filing system that Ohio put together a few years ago to minimize the impact on companies where they have multiple filing locations. So with this, you would elect in to this filing system. You would file one return with the city or the state of Ohio, and then they would allocate that income amongst all the cities. They would collect one payment for all those cities. And you would have one extension if you're filing it, one return, one set of estimates throughout the year. This would definitely reduce this burden. Like I mentioned, there's a requirement to elect into this filing system. So at the beginning of the year next year, you have until April 15th, 2022 to elect in. This would be done through the Ohio Business Gateway. One note to say, this deadline used to be as of 3/1, but it was just moved to 4/15 to correspond with filing deadlines. Next, I'm going to talk about the states, because in addition to filing in most states, back up one slide, Stephanie. So talking about the states, in general, companies have nexus where they have employees, where they have people, and where they have property. This may or may not cause a filing requirement in those jurisdictions, but companies have changed the way they're operating, and they may have employees as they're recruiting to find good people to work in different states. Or, as we had noted before, businesses are changing the way that they're operating. So it would be a good time at year end this year to revisit where you have people, where you have property, how you're doing things, to determine if you have some exposure out there, if you may have another filing obligation that you should be considering, or maybe you want to change the way you're doing things to fit your new business model. So now we can change the slide, and we're going to talk about looking forward to 2022. And there are some potential legislative changes that are on the horizon. So first, the Infrastructure Investment and Jobs Act. This was just signed into law yesterday by President Biden. So this was primarily focused on improvements to roads, bridges, public transit systems, and expanding broadband and internet and drinking water to more people. But there are a few tax pieces that were also in this legislation. The first is the one that got the most press, the employee retention credit. Unfortunately, many companies are not going to be able to take advantage of this now in the fourth quarter 2021. It retroactively changed the ending date to 9/30/2021. So most businesses will only be able to, if they qualify, will only be able to take the credit in 2020 or the first 3 quarters of 2021. And the fourth quarter 2021 is only available for new startup businesses that began during COVID. These are referred to as recovery startup businesses. So I'll talk more about the employer retention credit later. In this legislation, there were also filing extensions for either with the IRS or with the tax court for certain groups. These would be people that are in combat zones, active combat zones, or in a federally declared disaster area. So they were having trouble filing petitions in the tax court timely or getting the returns done with the IRS. So it included extending for certain groups these deadlines. And then there were also some excise tax changes. So they were either extended longer or old ones were now put back into service. And then there's also some filing requirements for virtual currency. Then we have the Build Back Better Act. This is part of the budget reconciliation that everybody's been waiting on to see what will happen, what compromises will go in place, and what will ultimately be passed. This is still ongoing. And I know everybody in my profession and many business owners were shocked when they pulled out this tax rate increases for individuals and corporations. All year, we've been talking to people about considering accelerating income into this year, delaying deductions into the future, and thinking about that for 2021, because we're expecting those tax rates to increase. But as of right now, that's not in the legislation. The estate tax changes were also pulled out. So many people were trying to scramble to think about gifting or moving assets, but those have all been pulled out. So some items that are currently still in there. Corporate alternative minimum tax that would apply to companies that have over $1 billion in book profits. So what this is focusing on is saying those large public companies that are showing record profits on their books, but barely paying any tax. They're trying to capitalize on those pieces. A surcharge on high income individuals. These are primarily aimed at people that are making over $10 million a year. And for trust and estates, they're having lots of money coming in. They're looking at increasing that surcharge as well. And then they're focusing on international business. So these are tax rate increases for global intangible and low taxed income, which is referred to as GILTI, or the foreign derived intangible income. So they're really focusing on those people that are very wealthy or overseas. Some items that may also be getting added in that are being talked about are the mark-to-market regime for very high income individuals, trusts, and estates. So if it's holding a large appreciated asset, they would then need to mark it up to the value currently and then pay a tax on that piece rather than waiting until they sell it and the gain's actually recognized. And a potential increase of the state and local tax deduction limit from $10,000 to $75,000. Tyler will talk more about these individual tax potential changes during his section. So I just want to reiterate, the items I just discussed for the Build Back Better Act are still being discussed. They can be changed, things can be put in, things can be taken out. We don't know, except for looking at our crystal balls to see what may actually happen. So as we're considering 2022, there are some changes that will go into effect unless legislation passes that would change these items. So I'm going to start this section though with a polling question. So I'm curious, have you or your company been involved in research and development in 2021? So as we await these results, I know a lot of companies have been taking a step back since they weren't meeting with customers in person, and they were they were looking at rechanging things and focusing on this research and development area. So the R&D credit, this is something that a company can take advantage of if they are doing projects and experimentation. There's uncertainty in developing something. So they're looking at either a software or a product to change, and there's uncertainty surrounding it. And they may fail, they may succeed, it may be available or may qualify for an R&D credit. Otherwise, they have R&D expenses that they can immediately deduct under the current law. So all of these expenses currently can either be expensed as they're incurred or capitalized and amortized over 60 months, which is 5 years. But in 2022, this is going to change. A company will not be able to deduct those expenses immediately, even if they don't qualify for the credit. So if you're doing this R&D activity, you will need to take all those expenses and pull them together and then capitalize them and amortize them over the 60 months. If you're doing this R&D activity internationally, you're getting hit even harder. You're going to capitalize and amortize these expenses over 15 years. So for companies that have a large amount of R&D activity, this could definitely increase their taxable income in 2022. Another item that I want to discuss that will be changing in 2022 that could impact quite a few businesses is for these interest expense limitations. The Tax Cuts and Jobs Act, which went into effect a few years ago, had an interest expense limitation for large businesses. This was measured based on 26 million, an average of 26 million of average gross receipts. So many of you on this webinar may be falling below that threshold. Businesses that had over 26 million average gross receipts for their aggregated group for the previous 3 years had to do a test to see the amount of interest expense that they could deduct. So in order to do this, it was all based on an adjusted taxable income. They would take their taxable income, add back the interest expense, then they would add back the depreciation, depletion, and amortization. Then they take that number, multiply it by 30%, and that was the amount of interest expense that they were able to deduct. Unfortunately, this could be a large number for many companies that are highly leveraged with some bank debt. And that interest expense is limited then, either at the entity level or the individual level. In 2022, this calculation will change. You will no longer be able to add back the depreciation, amortization, or depletion. This will really hit manufacturing companies that have a large amount of depreciation each year. So in order to do this, then they'll multiply that by 30%, and that number is going to be a lot lower for the interest expense that they can deduct. So they may consider before year end, are they in a better financial position? Can they change the way that their debt's structured to start minimizing that interest expense? Can they lower those interest rates? Or are there different paths they can take with the business, as in not taking accelerated depreciation, increasing the income to allow those expenses to go through, and just defer those the depreciation or interest expenses? So these are all things to think about in 2021 as the effects that will happen in 2022 based on the current law, what you think may happen with the potential legislation as we're thinking about 2021. So let's start now talking about 2021 and what we can do now based on the current rules and what we're looking. Next slide. So as we're looking at year end, some things we can do. You can review your accounting methods. So is cash basis or accrual basis the best for you? As I had mentioned, that large business, small business piece with the Tax Cuts and Jobs Act, when this passed, it also said those businesses up to 26 million of average gross receipts, they can now be on cash basis. This threshold for changing to cash basis increased dramatically for many companies. And quite a few took advantage of doing that and putting a deferral for not recognizing their receivables. Or based on your situation, maybe the accrual method is more beneficial for you. So it's definitely something to look at and consider this year end. You should revisit your revenue recognition policy. Are you doing things properly for books and tax? De minimis capitalization policies should be revisited. Do you have one in place? Is it at the right level? For those of you who do not know what this policy is, this is an ability to deduct expenses that may otherwise need to be capitalized. For example, if I'm going to be buying a table, this asset will be available for me more than 1 year. It'll be useful for maybe 10 years. So you would typically have to capitalize that table. But if it's under $2,500, and this is the limit that they put in, I can then expense that item and I don't need to capitalize it for tax or book purposes. If you have an audited financial statement, that would then increase to $5,000. So any item that you purchase that's on a receipt, you do not need to capitalize and you can expense immediately. But you may not want to have those limits. For example, if you have bank covenants that you're worried about passing, you may want to use a smaller threshold of maybe $1,000 or $500. Or you may want to use the fixed asset listing to track the fixed assets you have in place so you know what you own and where you have them. Then you may want to have a smaller policy because bonus depreciation in Section 179 are still available. So you can take 100% depreciation in that first year. So you would end up at the same result for tax purposes. So another item that you may want to consider as we look back at the fixed assets, strategically planning for your fixed asset additions. If you want more expenses in the current year, look to what you may be purchasing in the first quarter or second quarter even of 2022. Do you need a new piece of machinery because your other one's wearing out and breaking down? Consider purchasing that before the end of the year and placing it in service to get that depreciation. Or you may have an issue with your cash flow. So maybe you don't want to do that. So you don't want to purchase a bunch of fixed assets or even supplies before the end of the year that you may not need if you can't afford it, if your cash flow is going to be difficult for you at the end of the year. So you can't let tax deductions drive your business decisions. But the next item I want to talk about is the accelerating or delaying income. As I mentioned earlier, based on the legislation we were expecting to pass, we were expecting tax rates to go up. So we're back to thinking delaying income, accelerating deductions may be best for most taxpayers this year. But you may be in a situation that you want to look through to who's ultimately paying those taxes and see what their tax situation is. So for partnerships, you're going to want to consider what your ultimate owners have going on in their personal income tax return. Are they close to a threshold for the child tax credit? Are they going to go over that threshold this year? Or are they a specified service business? These are businesses that are in an industry like accounting or law or consulting. So for the qualified business income deduction, this is the 20% deduction that you have based on that income. These rates get phased out, or the deduction can get phased out if you're over a certain income threshold. So your business may be down this year in 2021. And in the past, you have exceeded this threshold, so you haven't been able to take advantage of it. And going forward, you're expecting to be high again. You may want to pull some of that income into the current year to take the best, to be able to utilize that 20% deduction this year and maximize that deduction because you otherwise don't get the benefit. And what do you think is going to happen with tax rates? Do you think that piece is going to get pulled in? We don't know, but it's based on what you think may happen. And the end of the year is still coming, so hopefully we'll know what that package says before then. And also, if you're a C corporation, you will want to look at if you have net operating losses out there. Also for individuals, you may want to consider this as well. But if you have losses from pre-Tax Cuts and Jobs Act that expire, now they go on indefinitely. But if you have those losses that may be expiring soon, you may want to pull some income into this year to utilize those losses before they expire. And don't forget to look through to your state losses or any city losses you may have, because you may want to trigger them this year before they're lost. So as we're thinking about all these different things, with that, I also want to mention basis and distributions. So If you are a pass-through entity and you have basis, if you're in a position where you have a loss for the year, that loss may be suspended on your personal return if you don't have enough basis to take it. And if you've been taking distributions all year, do you have enough basis to take those distributions? They may trigger a capital gain. So those are things that you're going to want to revisit and think about before year end, before any final decisions are made. So before I start talking about meals and entertainment, I want to take another poll. I'm curious to see how you're meeting with your clients and your networks and your advisors right now. Are you meeting in person? Are you golfing with them? Are you going to restaurants? Are you meeting in an office, virtually, or doing a mix? So as you're finishing with this poll, this Tax Cuts and Jobs Act that I've mentioned a few times, many business owners were disappointed and their employees when they came out and said, entertainment's non-deductible. So if you take a client to a baseball game, those tickets, you don't have a business deduction for them anymore. But if you go to dinner beforehand and you're discussing business, those items are still 50% deductible. The restaurants were really suffering during 2020 and 2021 as people were staying at home, not going out, concerned about getting sick. So legislation was passed for 2021 and 2022 that business meals at a restaurant are 100% deductible. I just want to remind you, these business meals, they have to have a business purpose. The owner or an employee needs to be present and business needs to be discussed while you're there. So meals that come from other places such as grocery stores, if you're stocking a lunchroom with different snacks or different things, those are all still 50%. But if they're from a restaurant, if you're bringing in meals for training or you're meeting with your clients, those are 100% deductible in 21 and 2022. So if you're not already identifying those in your records that you're going to be providing to us, we will be asking for that detail to make sure you get this deduction in 2021 and next year. So the last item that I want to discuss are federal tax credits that you should be looking into if you haven't already for this year. So the employee retention credit first. So this one is one that's gotten a lot of press and we've had lots of conversations about. This is for businesses to keep employees on payroll. They wanted employees to stay employed and businesses not to lay people off if they're having a hardship. So in order to do this, they then are looking at, started in March 2020, and it's going forward through for most businesses, the third quarter of 2021. If you had a partial suspension of your business operations, a full suspension of your business operations for that time period where you were required to shut down if you were not an essential business, or if your gross receipts are significantly down from the same quarter in 2019 as compared to the quarter in 2020 or 2021, then you can qualify for this credit. The threshold for significant gross receipts and the amount of credit per employee, it differs depending on the quarter you're looking at. But this is definitely something, if you haven't already looked at, that you'd want to look at before year end. And that fourth quarter 2021. Additionally, if you're a recovery startup business, one that began, there's another credit, piece of the credit that's a little different in that employee retention credit for you. So you're going to want to take advantage of that if you qualify. There's also payroll tax credit for COVID-19 sick and family leave. So if an employee is needed to take time off to care for themselves or a family member, get the COVID shot, there was a tax credit for that as well that you could look at. The R&D credit, like I had mentioned earlier, take advantage of this if you're doing some experimentation, if you're designing something that there's uncertainty around. One item to note though, with the R&D credit, you can't use the same wages for the R&D credit if you've taken the employee retention credit for those wages. So there will be a little trade-off there. There's green business credits still, renewable energy incentives under this, energy efficient building credits, alternative fuel, electric hybrid vehicles. Those can all qualify for a credit, as well as some other pieces in there that you can look into. There's a work opportunity credit for hiring and retaining individuals and specific targeted groups that have employment barriers. And there may also be some specific industry credits as well that you may want to look into. So these are all items, everything I've talked about today, for you to consider when you're talking with your tax advisor before year end. So I'm just going to check and see if there's any questions right now. And it doesn't look like there's any, but as you're thinking of them from my presentation or while Tyler's talking, make sure you put those in the chat box. And I'm going to move it over to Tyler to talk about the individual and estate piece.
Thanks, Melissa. I really appreciate all that information. I have a 2-year-old daughter at home, and so I work in the office because when she comes home from daycare about 3:30, it's knocking on the door slamming, daddy, daddy, daddy. So I cannot get any work done at home after 3:30. All right, good morning. As I mentioned, my name is Tyler Chaplin. I'm a tax manager here at BMF. I'll be honest, I was up until about 11:30 last night just refreshing Google to see if there were going to be any other tax changes, because knowing my luck, something would come through the day before a presentation. Luckily, nothing came through late last night, so we can continue. All right, what I first wanted to talk about was just some tax changes that are happening for 2021, and then we can talk about some tax planning opportunities. The first change to 2021 versus 2020 is the child tax credit. This child tax credit, the credit increased to $3,000, and that's $3,600 for children under 6 years old. The old credit was $2,000, if you recall. There's new reduced income phase outs for that full $3,000 or $3,600 credit. The full credit for married filing joint is if the adjusted gross income is under $150,000 for married filing joint, and then single for $75,000. Now there still is that $2,000 credit. Those income limitations go up to about $400,000 for married filing joint and $200,000 for all other taxpayers. Another major change to the child tax credit is that children 17 and under are now eligible. Before it was if the child was under 17, but now Congress has added children 17 and under. So if your child was a straggler last year, you thought you were maybe losing them as a credit, you'll get that this year again if they're 17 years old, if you're eligible for the child tax credit. Another change to the child tax credit is the advanced child tax payments. You may or may not have been receiving either a direct deposit or a check in the mail. So that is a prepayment of these child tax credits. You'll get half during the tax year. If you've been receiving these advanced payments, your refund may or may not be smaller than what you've been expecting. Also, advanced payments are based on 2020 adjusted gross income. So if you have been receiving those advanced payments, yet your income is going to be much higher than your 2020 levels for 2021, you may not be eligible for that child tax credit, and you may have to pay some or all of it back. So just a heads up there, we can do some tax planning if you're interested in that. All right, another big change for 2021 is charitable contribution increases for non-itemized filers. Previously, last year, there was a $300 deduction for either married filing joint or for all other taxpayers for the charitable contribution, even if you do take the standard deduction. This year, there's $600 for married filing joint, and then $300 for single or married filing separate. So if you do take the standard deduction, make sure you take advantage of that charitable contribution before year end. Okay, and then the last major change are required minimum distributions, or RMDs, for 2021. They're back on the table. If you recall, back in 2020, those were suspended, but unfortunately, they are back on the table for 2021. So if you haven't received an RMD for 2021 yet, please go ahead and contact your financial advisor. All right, let's go ahead and get into some tax planning and what we can do before year end and some legislative changes. Melissa touched base on some of the changes with the infrastructure bill and the Build Back Better Act, but let's go ahead and first start off with the infrastructure bill. It was signed by President Biden yesterday. There are no individual income or capital gains tax rate increases. Really, the only big change for individual tax purposes are their stricter cryptocurrency reporting requirements. We're not going to get into that today, but if you do trade or sell or buy cryptocurrency, be wary that there were some changes in the bill that was signed yesterday by President Biden. There's also the potential changes under the Build Back Better Act. As Melissa indicated, that is still pending. It goes back and forth about once a week. When we started planning for this meeting, for this webinar, we had a lot more different things than probably what it is today. So right now, there are no individual income or capital gains tax rate increases. However, there are potential surcharges added. And what that is surcharges are part of the proposed BBB Act. Right now, there's a proposed 5% surcharge tax on modified adjusted gross income in excess of $10 million. There's an additional 3% tax on modified adjusted gross income in excess of $25 million for individuals. There's also a proposed surcharge tax on estate and trust. That is for modified adjusted gross income of $200,000 and $500,000. So those income limits are pretty small for estates and trusts. So be careful if you do have any estates or trusts, there may be potential a surcharge tax. So what does that mean? That means the potential max individual tax rate could be 42% on ordinary income for modified adjusted gross income in excess of $10 million. So be wary of that. There's also the potential for a 45% income tax rate for modified adjusted gross income over $25 million. So if you are in that high income bracket of 10 million or 25, be wary of some potential surcharge taxes that could be coming your way under the Build Back Better Act that's being proposed right now. There were questions in the BBB Act of whether there was going to be a deduction on QBI, that's the qualified business income, for certain high income individuals. That's been scrapped. So there was talk about previous reiterations about limiting that for high income individuals. That is not the case in the proposed legislation for the BBB Act currently. There's also talk under the BBB Act of a potential increase or the elimination of that $10,000 limit on state and local tax deductions for 2022. If you recall, right now there's a cap of $10,000 for itemized filers for state and local taxes. That could potentially increase to $75,000 or $80,000, or it could be eliminated. We'll keep you updated on that. So if you are over the $10,000 limit currently in 2021, it may make sense to wait to make any tax payments for state and local to 2022 for individual filers. Okay, so since tax inquiries aren't increasing as of right now, potentially, it may make sense to, though, pull income into 2021 and defer deductions to 2022. If you're expecting rates to rise in future years, or if your tax situation is changing, it might make sense to pull income into 2021. So how can we do that? Well, one of the ways is to accelerate your installment sale gain. If you have an installment sale note out there and you've been receiving periodic payments, it may make sense to reach out and see if we can accelerate those payments to recognize all of the note in the current year. Another way to increase your adjusted gross income before year end is to, of course, recognize any capital gains. Look at your portfolio, talk to your financial advisor, and see if you can cash in on any of those big winners you have out there. Finally, another way to increase adjusted gross income before year end is to convert traditional IRAs to a Roth IRA. If you recall, traditional IRAs contributions are pre-tax, but distributions are taxable. Roth IRAs are the complete opposite. Contributions are post-tax and distributions are tax-free. So converting to a Roth IRA makes the full amount taxable in the year you convert it, but it allows future payments to be tax-free in the future years. So something to consider. I have a lot of clients that always wrestle with whether they want to convert from a traditional IRA to a Roth IRA. So please contact your tax advisor on that. There's also the potential to decrease AGI, or your adjusted gross income, before year end. If you're expecting rates to stay the same or your income may be down in future years, it may make sense to lower income now for 2021. So here's how. Of course, you can look through your portfolio and recognize any capital losses. See if you can sell off some losers. Remember that you can only recognize a capital loss of $3,000 and the rest carries over. So be wary of that. Make sure you offset any capital gains with any capital losses, but you can't take more than $3,000 deduction. Also be sure that you're contributing to retirement plans. Before year end, max out those 401ks and traditional IRAs. Be sure to look at that. Also, contributions to HSAs or FSAs. For single individuals, maxing out is $3,600 for HSAs and $7,200 for married filing joint, with the $1,000 catch-up contribution if you're 55 or older for HSAs. For FSAs, the max for healthcare contributions is $2,750 for 2021. Another way to decrease your adjusted gross income for the year is deferring any debt cancellation events. Are you expecting forgiveness of debt? It might make sense to push that into future years so you don't need to recognize income in the current year. And then one of the other ways to decrease your adjusted gross income is to, for qualified charitable distributions from a required minimum distribution. If eligible, taxpayers can divert their required minimum distribution into a qualified charitable distribution. This is eligible for both itemized and non-itemized taxpayers. This reduces your adjusted gross income, and distributions are not considered taxable income. Okay, so next slide, good. All right, so again, as we mentioned, capital gains rates are likely to stay put for 2021 and 2022. They may increase later. We don't have that crystal ball. We're not sure what's going to happen. But again, it may make sense to recognize any long-term capital gains now, then buy back, right away. Be very cautious of any wash sales. But if you recognize gain now at the current rates, you lock in the gain, and then you can buy that stock and investment back if you want to take on the future appreciation. Some other tax planning opportunities is the passive activity limitations. So what is a passive activity limitation? Code section 469 delves way deep into this, so we're not going to get too far into it, but passive activities are like rental properties or an investment in a business that you're not directly involved in, but you're invested into. IRS has strict rules on passive activities. For losses, they're suspended. You cannot take losses until you have income or until you sell off that passive activity. So one of the ways to free up some of those losses is, hey, maybe to increase your participation in that passive activity by year end. IRS has strict rules about these passive activities again, but one of the most common components is working in the business for at least 500 hours during the year. So if you do have a passive activity that you're maybe at 400 hours, I guess get to work and take part in that passive activity. There's also the opportunity, the planning opportunity, to sell those passive activities before year end. Again, this frees up some of your losses, and so you can take advantage of those losses that have been suspended from previous years. All right, also wanted to talk about itemized deductions. For 2021, the medical expense floor of 7.5% is now permanent. That's 7.5% of your adjusted gross income. If you have medical expenses of 7.5% of your adjusted gross income, you can start taking those medical expenses if you're an itemized filer. One tax opportunity is to bunch deductions. And what I mean with that is, let's say you're having, you're scheduled for a surgery, but you're also going to have a lot of medical expenses in 2022. It might make sense to take the standard deduction for this year, pass on the surgery until next year, assuming it's not life-threatening, and then take that in 2022, take that surgery in 2022, so So you can bunch all of those deductions. The standard deduction for 2021 is $25,100 for married filing joint filers, and then $12,550 for single filers. You can also do this with charitable contributions. And so you haven't contributed much to a qualified charitable organization this year. Maybe you take the standard deduction this year, and then on January 1st, you start making all your contributions, and you can bunch all those together for next year. Makes sense. All right, the adjusted gross income for qualified charitable cash contributions in 2021 is disregarded. In previous years, it was limited to whether it was 60% or 50% of your adjusted gross income. Well, in 2021, cash contributions to a qualified charitable organization is not limited by your AGI. So you can contribute up to 100% of your adjusted gross income if you choose to. However, cash contributed to a donor-advised fund is limited to 60%. So be wary of the organizations you are donating to. There could still be some limitations. Limits on appreciated stock is limited to 30% for a public charity and 20% to a private foundation. So again, be wary of where you're contributing because there might be some limitations. On that note, consider donating stock with high fair market value and low basis. You won't recognize any capital gains, and you'll have a deduction for the fair market value. Remember, you do have that 20 to 30% limitation of your adjusted gross income. All right, and so now I want you also to be wary of the net, thanks, Stephanie. Be wary of the net investment income tax. This is that 3.8% tax on your net investment income or the excess of your modified adjusted gross income over $250,000 if you're married, $125,000 if you're separate, and then $200,000 for all others. So be very wary. You might have some of your portfolio income might be taxed on a 3.8% tax if you're over a certain modified adjusted gross income. There were prior talk and prior legislation that the net investment income tax would be for high income earners from pass-through entities, whether you're active or passive, but that's been scrapped in the latest reiteration, so nothing to worry about there. All right, and then some gift and estate planning. The annual gift tax, can you jump to the next slide, Stephanie? Okay, perfect. The annual gift tax exclusion for 2021 is $15,000. This is scheduled to be $16,000 for 2022. So, and this is $15,000 per person and spouse. So if you donate to one of your children, you can donate up to $15,000, you and then your spouse. And then if that child is married and they have a spouse, then you can do another $15,000 to their spouse for both you and your spouse. So that's $60,000 total that you can make exclusion eligible gifts. So be sure to do that before year end. Again, that's going to jump up to $16,000 for 2022. So if you'd really like to surprise somebody, you can do $15,000 before year end, and then another $16,000 maybe on January 1st. Nice holiday gift there. Also, the gift and estate tax exclusion amount is currently $11.7 million per person. That's $23.4 million for married filing joint. I'll be honest, when I first started planning for this webinar, I had a long list of potential talking points because legislation was still up in the air about grantor trust changes and estate law changes. Well, to be honest, under the proposed BBB Act, those are all scrapped. There's no changes scheduled under the BBB Act. They're really not touching estates or trusts. I do want you to be wary, though. In 2026, there are going to be some changes. Federal exemptions are planned to reduce to $5 million as indexed for inflation. So again, right now it's $11.7 million per person. It's planning on dropping to about $5 million in 2026. So be wary of that. Be sure to use up some of that gift tax exclusion. And I'm going to put up a poll here. to see if you've done any gift or estate planning. Have you considered it? Is it on your schedule? Is it on your radar? Is it something you'd like to schedule to revisit? Let me know your thoughts in the poll. Okay. All right. I'm going to turn it back over to Melissa to see if we have any questions. Thank you so much for your time today.
Thank you for the insight, Tyler. We do have a question, and other people, if you have questions out there as well, please put them in the Q&A box. We'll try to get it to as many live as we can. But the first question is, can you repeat the information on the contributions to donor advised funds?
Sure. Cash. So again, there's no limitation for AGI for cash charitable contributions made in 2021. However, cash contributed to donor advised funds are limited to 60% of your adjusted gross income. So if you're approaching that limit for your adjusted gross income, be wary of that, because you can't contribute more than 60% of your adjusted gross income to a donor advised fund for 2021. And let me know if you need me to clarify anything further too.
Okay, I don't see any other questions out there, but if you have any other questions, if you have those additional questions afterwards, you can send your questions to myself or Tyler at our email addresses above, or at info@bmf.cpa. And we want to thank you for joining us today.
We do have one more question.
One
One more question that came in. It says, is the QBI deduction still in place on federal for 2021? And Ohio is still observing the business income deduction. So QBI is still in place for the federal income taxes for 2021. And then Ohio still recognizes the Ohio business income deduction. So, and that's up to $250,000 for Ohio. And then after that, it's taxed at the more beneficial rate of 3%. That's for any business income in Ohio. Good question.